All right. Well, welcome back to the iWealth podcast. And today we're talking about Q2 of 2023. And the big picture question is, from a 20,000 foot overview, what all happened, and kind of give us the recap.
Yeah, well, I won't make this a half hour long, Matt. That's for
Thank
sure.
you.
And I do have some notes I want to compare to, but it's been a pretty good start of the year. Last year, you had bonds down 13, S&P down 18, Russell 3000 down 30. Like, it was a tough year wherever you were. If you were able to weather that storm, stay invested, it actually turned out pretty good. First year, S&P was up 16.89% so far, and so it's doing really, really well. But here's the caveat. The top 10 companies make up 95% of the index return. So the index is not equal. It's not 500 divided by equal. They overweight. Some of these technology companies that are in the S&P 500 did really, really well, which means that the index did well. Meanwhile, I take a look at the Dow. The Dow is only up 4.94. So Dow's up 5%, S&P is up 16% because of that weighting. So it's just really interesting. Never really seen that for quite some time. And then bonds were up 2%. So we're back to normal bonds. Maybe we'll get 3-4%, 5%, depending on what kind of bonds you're in. So bonds had a pretty good year. So bonds are up, Dow is up, S&P's up. We had the Silicon Valley Bank closure that happened. We had another big deal, yeah. Fed bailed out the banks, and whether it was right to do or not right to do, they've been able to kind of take care of that issue. I don't think it's fully behind us. I think there's still some banks in trouble. We had the debt ceiling debate. If you remember that, how quickly we forget, but we had the debt ceiling debate, and the House was able to negotiate with the White House, and they were able to get that debt ceiling pushed off. So we didn't default on our debt, which would have been catastrophic when it comes to the markets. And so that was, kind of done and behind us. And then employment was strong. We have 10.1 million job openings as the end of April. That was, down from the peak of 12 million March of 2022 coming from COVID. And then it's still above 7.2 that we had January of 2020. So, there's a lot of jobs out there. But locally, I was just with the business group this week, Matt, and two of the business owners that were in there, it's up in the Minneapolis, St. Paul area, two of the business owners in there have record amount of backlog, meaning they've booked business, they have cash, like stuff's coming in, it's really, really busy. But there's a couple other that have really starting to think about layoffs. And it's the first time I've heard it since COVID.
And so what about, in particular, like the interest and interest rates? Where's that going?
Yeah, it's, you finally get it's one of my takeaways at the end, like what should you do? Because the interest rates are in that 4 or 5% range. You can finally get some earnings on your cash that you have. But when we talk about inflation, since peaking at 9.1% in June of last year, we've had 12 straight months where it's fallen. It's now at 4%. Okay. So inflation is coming down. And so whether we have a soft landing, you listen to the pundits on TV, we're going to have a soft landing on these raises that we're seeing from the Fed, we'll see. But the people we follow think there's 25 to 50 basis points more raises. Could see a raise in the next couple of weeks in July, but we don't think they're quite done yet, but getting really, really close to the end of that cycle. Ironically, both of them think that we're going to have a recession next year. I think it could be first quarter of next year. Keep in mind, markets are ahead of that. By the time they say it was a recession, the markets are already farther ahead of that. So it's really hard to time. You can't just get out of the market. But both of them think that it's going to be a mild recession. They don't think 08 and 09 are here again. Yeah. So when I back up and kind of go through this whole thing, the bank failures, the CPI is coming down, inflation's coming down.
Okay.
The conversation I had with business owners in the cities where they're starting to talk about some layoffs. Like, one of the things the Fed wants is bad news. They want unemployment to go up. They want more people unemployed, which is weird.
Yep.
Biggest employer last month was the U.S. government. So they're hurting themselves. They keep hiring everybody. They should just leave on unemployment if they want to hit their numbers. It's kind of crazy. But anyway, so I tend to believe that it'll be a mild recession based on people I'm seeing. And so then the question is, what should you do? Right? When I went through and I put this data together and started looking at this, and I talked to people much smarter than me about the markets and things, there's three things that came up. So number one, be invested and have the goals in mind. So I've talked about this a lot when you and I get together. Like, if it's retirement and it's 15 years away,
Yep.
does it matter today whether the Fed raises 25 basis points or not? Probably not, right? So keep in perspective. If you're going to retire next month, it matters. And you better have some money protected before you retire so that you don't have to spend something in case the markets get jittery and go down. So be invested for the goals you have in mind. Number two, cash is paying over 4%. Liquid cash, very little risk. If you're sitting in an account getting 1 or 2%, you should be looking around for alternatives, asking people if you can get a better rate on your cash, like it's paying 4%, like you need to get it. And if not, give us a call and we'll have a conversation with you about where you can get 4%. And lastly, stick to your plan. If there was a plan put in place 1 year, 3 years, 10 years ago, stick to your plan. Things are not different this time, and we'll get through this. But it's been a really good start to the year, Matt, and we needed it based upon the crap that we went through last year.
Where we ended up with the major dive at the end of last year.
Yeah.
Very cool.
But if you pay attention to the news cycle, they're going to make you feel like the markets aren't up and everything's negative. It just depends on what channel you're watching, I think. But overall, you know, when statements come this second quarter, they're going to look a lot better than they did a year ago. So,
very cool. Well, thank you so much for spending a little time with us, and we'll see you back here next time.
Thanks, Matt.